Welcome, everyone. I'm Angelo Robles, and welcome to At Family Office, and for my members of SFO Continuity, welcome. We are recording this in a private recording. It's mid to late December as we're wrapping up the year, and I have been doing a little more because you are all asking for it in the last month or two on my dives into investing in real estate. So it's been a great blast. It's not where a lot of my experiences lie, but I'm definitely curious. And of course, I'm familiar with the math that real estate is a common interest and holding among the ultra high net worth and, of course, family offices. We have a special guest today because I don't like to do overly traditional or boring reads of a title. How about this title? Today we have on the Real Estate Philosopher. So that's going to make up my title. I connected with him a couple of months ago. I've enjoyed his work from afar for a long time, and that would be Bruce Stachenfeld. And I'm going to start with little fanfare. Bruce, welcome to the show.
Thank you for having me here, and thank you for saying something that I hope is true, that philosophy is not boring, because you said it's not boring, and yet I'm a philosopher. But I'll leave that to you.
Well, you might be. Let's see. I'm going to test my knowledge now. The niche of real estate. How about that?
All right, I'll go with that. That's pretty good. Go for it.
That's not half bad. At least I'm a fan. It causes you to think and think differently, and that's really what matters. And maybe on that note, Bruce, it's a great moniker to have. You've earned it over decades. And kind of how did that come about? Have you studied philosophy? How does that impact to real estate? And where do they kind of meld together?
Well, let's see. There's a lot of pieces to that. It probably makes me a bit of a nerd. But even in high school, I used to sort of have this little hobby of like thinking of things. And, I shouldn't even admit this because I guess this is being recorded. But I would walk around a little pad and write thoughts down. And probably everyone thought, well, he's never going to get a date. That's for sure in high school. And I didn't. Went to college.
You made up for it, Bruce. Come on. It's okay.
I married ridiculously well. I've been married 40 years and nuts about my wife. So I got lucky there, but it didn't start as well as I wanted. Went to college, majored, yes, in philosophy. It's always been a hobby. And I wanted to become someday a professional philosopher. And I guess I am now a professional. Unfortunately, philosophers, amateur or professional, don't really earn any money from it. More seriously, I think it's probably around 10 years ago, I started, trying to write something. I didn't want it to be a blog or, a newsletter or one of these things like everyone else is doing. It was more like, let's apply, my brain power, whatever it is, good or bad, to the real estate industry and try to come up with things. And just not necessarily speak about what everyone else is speaking about, because honestly, I'm probably not smarter than everybody else. And what am I adding to the conversation? So I always try to come up with things that are not necessarily mainstream, but might apply to the real estate world. I found a lot of times the articles that I've written end up an idea from another industry that applies in real estate, vice versa. But it's been something that's kind of taken off. I think it's been about 10 years. There's probably been about 100 articles. And it goes to about 50,000 people, and people seem to like it. They read it. So as they tell me, I have no clue what I'm talking about. One guy told me, I think he actually was nice enough to email say I was just plain stupid. And sometimes other people like the articles, but I'm proud of it. And it's something that, kind of does define who I am.
Real estate is a very competitive industry. You've written about in my show notes about creating deals versus sitting back and sort of finding them. You're taking action. You're making things happen if you want to be successful, very successful in real estate. What do you mean by that? And what could investors, allocators, family offices do to make things happen?
To the extent I'm famous, and I have no clue if I really am, it is my most well-known or famous article, which was entitled, "You Will Never Find a Good Deal Again." I wrote that about, 3 or 4 years ago. And then about a year ago, I wrote, "You will never, ever find a good deal again." And what did I mean by that? Okay, if you think about finding a deal, what does that sort of mean? It means you're probably sitting somewhere on a computer screen and deals are being sent to you, and you're looking at them and trying to pick the winner, which the best one. And in the old days, I don't know, 20 something years ago, you probably could find a deal. The deal wasn't known by everyone. You walk by the site, you see this, you hear that, and you could find it. But today, things have changed so much. I mean, the first change was maybe close to 20 years ago that has sped up dramatically, which is just the internet. Everybody kind of knows everything. So the thought that you're going to sit there looking at a screen and somehow you're going to be able to figure out something that nobody else figured out, and you're going to get something that, is better. And not only that, you're going to be able to do that again and again and again, so that on a long-term basis, you will outperform. I believe the chances are mathematically close to zero. That was bad enough 3 or 4 years ago. But now with this thing, flopping around called artificial intelligence, AKA known as AI, it's even worse, because everybody theoretically knows everything at the same moment. And then there's the collective brain power of humanity kind of blasting away at it. So my thesis, and I really do think I'm right here, is that if one wants to outperform in the real estate world on a long-term basis, finding stuff is just not going to cut the mustard anymore. Instead, you have to create stuff. You have to have some sort of vision and put something together that everyone else isn't able to put together. And it could be because the market, this, that, a property, I think. But one way or another, I think the game is upped. You have to be able to create something rather than find something.
And I mean, that sounds great in theory, and how could it not be correct? But now I'm going to have some knowledge. I'm going to have to really roll up my sleeves, and maybe I'm turning what some people in real estate call acres into feet. I'm buying, even if it's land, I'm doing zoning, I'm now active in building or refurbishing or converting. That's a lot of work. If I'm most people that didn't make my living, my blood, shed blood in real estate, like that sounds hard to do, to create, so to speak, from the ground up. Where do I even start?
Well, here's an interesting thought. I just actually was thinking this as you were speaking. You don't necessarily have to outperform. I mean, when you really think about it, what was the guy? I forget the name of the one of these investing geniuses. I'm not an investing genius. I'm terrible. But his theory was, not everyone should try to outperform. I mean, if you're a big, say a big, pile of money that's supposed to invest in real estate for pension funds, it's a lot more important for you not to underperform than it is for you to outperform. If you try to outperform, one thing is for sure, you will either be above or below. You will not be the same as everyone else because you're doing something different. So one easy answer to your question, which is not what you want, but might be the right answer anyway, is you don't have to try to outperform. Find all the deals you want, make sure they're sort of like middle of the road, and try to kind of do average. And my guess is for most players, that's probably perfectly good. And, my age as an investor, I give my money to my wealth manager and I tell him, look, don't lose it. I don't really care if you win, just don't lose it, please. So one angle for the real estate industry is just try to make sure you don't lose your money and you're average. That's kind of step one. Step two is if you really do want to outperform, you have to swallow hard and say, gulp. I might underperform. What will happen to me? Do I lose my job? Do I lose my company? Do I go out of business? Do I get sued? What happens if I underperform? If those risks are okay, then I can try to outperform, which is the things that you said. I have to figure out how to do it. Last piece is, how do you do it? Now, I don't want to sound like a humbug or whatever. Maybe I will a little bit. But I wrote a book a few years ago called If You Want to Get Rich, Build a Power Niche. And the power niche idea, I think, is one of the best ways to outperform. What is a power niche? Okay, a power niche is something that you don't find, you create. You look at something and you come up with a way of doing business nobody else is doing. And then you start talking about it. Since you created it, the second you came up with it, you kind of own it. The more you talk about it, the more you become identified with it. And then it starts to take on a life of its own because it's something you have the knowledge, intellectual capital, and even more important, all the different players in the game that do it. If you start doing something like this as a power niche, I do think it is one of the few ways left that you could outperform on a long-term basis. I could try to give an example if you want, if that would be helpful, or I can shut up and turn the microphone back to you.
No, it's very helpful, Bruce. My little experience, but technically as an investor in family office, but also knowing many way more successful investors than me, unlike most industries, real estate is very, very local and geographic. What works in New York may not work in Philadelphia, Boston. What works in San Francisco may not work in LA, Miami, or whatever, Texas. It's very local. And as an investor, I actually think it's relatively simple. Just like in anything I look to invest in, when I'm doing my thesis, what is the supply and demand? If there's less supply and more demand, well, then I might have tailwinds behind me. So do you agree that real estate is very geographic centric, and is your focus and experience, so we could focus on it, more so greater New York and or other areas?
It's interesting. It's a really good point that you make. Real estate is, even today, and this sort of goes a little contrary to my statement earlier, that everyone knows everything. Real estate is still ridiculously local and still ridiculously and based on like who you know in that locality. You're totally right. So if you ask me, Bruce, name like 10 major, even like 50 major players in New York City, I could probably give me 15 minutes, I can scribble them down. Ask me to name like 3 in Los Angeles, I don't know if I come up with any, Atlanta or any other city. And if you do that probably with anyone in another city, they probably heard of Silverstein because the World Trade Center, it's a horrible tragedy. And everybody knew he was the developer there. But does people in other cities really know all the players in New York, or even some of them? Answer's no. So strangely enough, real estate, you're totally right, Angelo. Real estate is still ridiculously local. And I think that, can help or hurt depending on, where you're investing and where your market is.
You're correct. And it could help, actually, which something that you said before that I'll try to tie in terms of average. Now, my audience knows I get a little up in arms over that because, of course, I want people to be incredible and to be great. And I know someone may have money and just may want a whole court. I could argue relative of inflation, distributions, and things they have no control over, monetary policy, interest rates, and really the true impact on their purchasing power. I'm not the biggest fan of that. Institutions are different, but I think when you're a family office, I like to see a little bit more swashbuckling attitude. If I just want average and don't want the hassle, now I'm not going to get the tax benefits. I may look at REITs or something that effectively is going to feel like a stock and is in the public markets. So I have to think, if I'm not doing it from the ground up or being a direct investor, Bruce, what are my other options besides what I said about playing a liquid market where I'm not going to get all the benefits of real estate? One would be I simply become an LP and someone who's just better at it and more experienced, but I am giving up control. And as you know, rich people kind of like control. An other option that is going to be more hands-on, but allows me to be a little deeper into the weeds, is I could co-invest with another family. How do you think how I broke down what options are for a family and advantages or disadvantages of any one of them or all of them?
Okay, that's kind of a hodgepodge of questions. So I guess, it's kind of funny. I wrote another book, not to keep talking about that. It's called How to Invest in Real Estate If You Know Nothing About Real Estate. Maybe that's kind of the answer to your question. So what do you do if you don't necessarily, maybe you do know something about real estate, but you don't have the time to evaluate every opportunity, or you have so much money that you want to, allocate it. So the things that I guess I would be looking at, the first one would be, I'm going to be either an LP or part of the general partner, but somehow I'm going to be co-investing with somebody else. So the first question is, how is that person running the deal treated differently than me in the deal? Now, he deserves better. I mean, he's the one who found the deal, put the deal together, hopefully created the deal, is creating all the upside. All I'm doing is writing a check. So yes, he should have a better risk-reward profile than me. I accept that. But the question is, how much? Second, along those lines is, if the deal starts to go badly, does he just collect fees and I sit there watching, the investment while away? Third, are there any even remote skeletons in that person's closet? There's an old saying, which I'm in my 60s now. I find it unerringly accurate. A man who will steal a chicken will steal a horse. I don't know that I've ever seen somebody that did something kind of sleazy that didn't do it again, but avoid those kind of parties. And then I guess the last thing that comes to mind as you ask this question is, I have learned over the years that somebody who is doing something that they really know what they're doing, they've done it again and again and again, assuming those other boxes are checked, the odds are really, really good that you're going to do well with that investment, outperform, if you will. On the other hand, if that person is wading into something new, like they always did multifamily, now they want to do retail, it doesn't mean they're going to fail, but I think the risk reward profile is poor. And that if you really were going to go with somebody who was changing their investment profile, you would want to be overpaid for risk, which is my little phrase. You would want to be thinking, and that has a dramatic upside because the chances of failure when this fella changes direction are higher. Those are the things that I think come to mind about, trying to avoid trouble when investing in a real estate transaction. We could delve deeper into the capital stack if you want as well, look at the different segments, but I'm trying to answer your question in a big picture sense first.
Of course. And I got questions from that, but why don't you give the audience a little bit of an understanding of a capital stack and what that could look like in real estate?
Okay, so a typical capital stack, somebody is buying something, we call it black egg or a law school. Somebody's buying an asset, and typically there's leverage and there's equity. The leverage, kind of comes from a first mortgage, could be a construction loan, could be CMS, could be anything. And there's often, anyway, high yield debt, which is anything from a B piece, a mezzanine slice, preferred equity, or something, a debt-like instrument. And finally, there's equity, which is the joint venture. Almost all the transactions have this, at least in concept. And then, of course, as deals get more and more complicated, sometimes the equity is an LP and a GP. Sometimes there's different levels of LP, different parties investing in the GP. There's syndications, all sorts of places to be in the capital stack. And depending on what you're trying to do, the risk reward profile is different. A lot of players tell me today this, and I think they're probably right, that non-bank lenders who are lending in a first mortgage position I guess this is close to your investment recommendation as I can make. Non-bank lenders who are lending on first mortgage positions in real estate in states that don't really beat the lender up too badly if the lender ever wants to foreclose. You know which states those are, like New York is a poster child for that. They're believing they're having the greatest time in history to put money to work. I've written some checks myself into that, hoping for the best, because they have a lot less competition than they used to. The interest that they're earning is robust. They can leverage that internally and push it up into the lower, even mid-teens, and pretty much have a really, really attractive risk-reward profile because they're in first position, maybe behind their internal leverage, but in first position, earning in over 10% in the low teens. That's pretty nice. And if you're, as I said, in a state where the borrower can't really beat the heck out of the lender, making them take like 3 years to foreclose if it ever gets to that, it's a nice place to be. So that's one thing. Where else is a nice place to be in the capital stack? There's this thing that you might have heard about. Actually, before I hit another one, the other flavor of the month. And this is a little harder to actually effectuate, but is very nice on paper, is what's loosely called preferred equity. I don't want to talk, I don't know how much sophistication everyone has, but sort of a short diversion there. So typically, you have a mortgage and then you have a mezzanine loan. Preferred equity is kind of the same economic proposition as a mezzanine loan, but it isn't a loan. It is actually a joint venture where the investor is investing in the joint venture as a preferred position. There's all different ways to do it. Lots of times people try to make it look exactly like a loan in the joint venture. and I have a cute little name for it. One of my partners came up with it. They call it schmez, which is, sort of like, it's like a mez, but it's in the joint venture. There is enormous demand from many players, mostly in the equity markets, but in the debt markets as well, to put preferred equity to work. The problem for, I'd say, almost all of them is there's not as much demand on the other side for it. So there's an imbalance. Many of my clients are saying, oh, I want to do this preferred equity deal. I'm going to see so many of them. There just aren't as many parties that want it as that have the money to do it. And I guess the reason is the risk reward profile is wonderful from the investor's point of view. I mean, you're ahead of the equity, right? And, you're hopefully hitting the teens of a return. You are behind only the first mortgage. It looks pretty sweet. But from the side of the party taking it, you have a real risk that, this capital is going to cost me 12, 13, 15, even 20%. If I take a lot of it, I may just end up working for that guy, and there's no upside left for me. So I want as little of it as possible, or hopefully none of it. I'd rather have plain old LP that shares with me, or maybe a bigger loan, whatever. So in any case, the risk reward profile is pretty wonderful from the side of the preferred equity provider, but kind of a nuisance or worse from the side of the party that takes it. Last one I'll mention, and just in terms of like roving the capital stack, how to kind of outperform, is what's loosely called GP capital. Okay, so what I mean by that is this. So typical deal, you're buying the property for $100 million. You're getting a, $60 million mortgage. There's $40 million of equity. It's a 90-10 deal, meaning the investor, the LP, is going to put up 90% of 40 or 36. And that means that the general partner has to come up with $4 million. Now, that sounds small next to 100, but for most people, certainly including me, $4 million is a lot of money. So the sponsor wants to build this building or do whatever it is, or buy the asset, and is stuck. Like, how do I get $4 million? I got $1 million. I can scrape together with myself and my dad and my family. I need $3 million. So one place to invest, and there's a big negative but a big positive, is to be the party providing that $3 million of GP capital. Now, if you think what happens, the typical deal is that the party who puts in that $3 million shares in the promote, which is the excess upside that the GP gets, in return for putting that $3 million in. So think risk reward, it's utterly fantastic because it's the exact same risk reward profile. It's the exact same risk as the LP. Your parity pass through with the LP, but the reward is higher because you're sharing in the promote. So it's like wonderful. Here's the bad news, though. It's complicated. It's tricky. It's annoying. It's a lot of work to write relatively small checks. And that scares most parties away. And that's the reason why very few are really able to pull it off. Because instead of a simple joint venture, the GP and the LP get together, lawyers yell at each other until it's done. You now have an internal joint venture in the GP that somehow has to kind of mesh around with the external JV with the limited partner. Anyway, it is a great place if you can figure out how to do it, but it's very tricky. Those are the easiest places that come to mind about how to be overpaid for risk in the capital stack. And I'll shut up, Angela. Sorry if I'm talking too much.
No, you're not talking enough. I think that's awesome. That's 3 good examples. I greatly appreciate it. Trust me, my audience feels I'm the one who talks too much in programs. So it's a pleasure to have someone who could kind of keep pace. I love it. The first example that you gave is pretty classic. If I'm maybe a significant family, I'm looking to be a first lender on a variety of things. Maybe the person's credit isn't perfect. I'm able to charge some of the prices that you noted. If I control the loan to value being what I deem to be reasonable, again, supply and demand, what's the interest in that given city, what sector of real estate, lots of moving parts. But there is one thing that could go very wrong that we started to see happen to some degree during COVID. My loan to value could get really askew if simply the price of the property drops, which I may have or don't have in theory, no control over. And we're assuming we're starting to see that now in some office building and other real estate that might have been 60 to 70% loan to value, but then it took a hit. The property prices dropped 10, 20, 30, 40% or more. And now the lender is coming due. And in my example, maybe the person who's the main purchaser is just turning in the keys. So how do you control? I guess the answer is you don't underlying value in a property.
This is another thing that we're probably talking about later in the call, but maybe we'll jump into it now. And that's the D word, diversification. Okay. The fact is nobody predicts like anything that's going to happen. Nobody knew it was going to COVID pandemic. Nobody knew that office was going to fall apart. Nobody knew retail was going to roar back to life after it looked left for the dead. You can't predict these things. We all think we can. We think we can predict the future, but our brains are our best friend and worst enemy. Because what our brains do is they remember so well when you were right. I knew the market was going up, and they forget when you were wrong. And probably almost everyone is relatively average at almost everything, with a few amazing exceptions with brilliant investors. So you say, okay, let's look at this risk reward profile that we were talking about. Your non-bank lender putting the money to work with a 60-65% loan to value on it. Now you can't do 10% loan to value because you haven't got any business. Nobody wants it. So you got to at least probably put out 60-65%. And you say, well, what about what you just said? Well, one thing we're sure of is we don't know what's going to happen. Any asset class could get smacked. Anything could go wrong. What's the best protection against that? It's diversification. So if you're doing that and you want it as best as possible, just for the point you just made, Angelo, what you should be doing is you should be putting those first mortgages to work in all different asset classes, all different geographies, as much as you can, because maybe office gets destroyed and hotels start to boom, but you don't know what will happen. Overall, you should still be able to outperform through the magic of diversification. So that is the best answer, but otherwise you're right. You can't be sure that an asset won't get crushed.
I should probably accept the answer because I think, broadly speaking, for most people, I think what you said is accurate. But Bruce, I just can't do that. Because I talked to a lot of people about Munger said, you only have so many great ideas. So I have 50 incredible ideas. I'm going to put 2% to each of them. No, I maybe have 1, 2, or 3. I look at Bill Ackman and others, not that he's done so great lately, but a lot of these managers, Leon Cooperman and others, when you look at their 13 Fs, they got 40, 50, 60% in like 3 to 5 holdings. I broadly agree with that. Otherwise, I'm just going to be beta and be average. Of course, we all have a swag and a confidence that we're not average. You hinted at that before, and your philosophy training and understanding helps you understand how we basically fool ourselves, for lack of a better word. But could I make the point that to be high conviction, to be concentrated, arguably is the way that we get rich and may not be the best way to stay rich?
You said it would be okay if we had a bit of a tete-a-tete. I'm going to disagree with you on this, okay? And it's going to be hard to really say what I'm thinking, so I'm going to probably babble a little. I'll try not to. Let me start with math. By the way, I was a math and philosophy major, proving my nerdiness even more. The social suicide, whatever you want to call it. There was a guy named Bill Miller. I read about this in the magazine. He's a legend, and he was legendary because he beat the S&P and the stock market so like 17 years in a row. Okay. And it was really cool that he was able to do this. And he was touted in somebody that really wasn't as good at math said it was something like 250 million to 1 chance that this was luck. Okay. He must be a genius. But then a real mathematician looked at it. So wait a minute. You're not doing it right. Let's look at all of the different managers that were doing this over the 17-year period. What are the chances that one guy by pure luck would beat the S&P every year, 17 years in a row? The answer, I think, was 87% likely. Now, do you still think that Bill Miller is a genius, or is he just the schmuck that got lucky? Because somebody had to get lucky. Ironically, right after the math guy wrote the book, Bill Miller got crushed the next year, and his long-term return, he's probably a brilliant investor, wasn't as good. So here's the answer to what you were saying. I think it's called confirmation bias. So John Smith goes to Atlanta and starts buying, single family houses, one after another after another. He does it for 30 years in a row, and he's a billionaire. Everyone thinks he's the greatest genius in the world. And maybe he is, or maybe it just turned out Atlanta 30 years ago was just going to keep doing well for 30 years. He put all his eggs in one basket. Maybe he just got lucky, or maybe he is a genius. So I guess what I would say in response to you is this. You look at Bill Ackman, Warren Buffett, and a bunch of other people. There's probably a few who really are geniuses and can actually outperform. And I would guess, and probably there's some mathematical way to prove it that I could never do, that most of the people that outperform doing what you're saying are getting lucky rather than good. And emulating them is not an optimal risk reward profile. I don't know if I said that right, but that would be
no. I mean, I hear what you're saying. What you're also describing, if I'm not just broadly investing in some equity plays relative to the real estate market, your approach is also harder. I have to source more deals. I have to monitor them. I have more negotiations. They're each a little nuanced and different. I have a little bit more headache in terms of the management responsibilities. No question, your way is harder. I do think you're probably right on dampening volatility by having more diversity. I wonder, and again, I'm more of an equities guy. I'm okay with volatility. I'm looking long term. I know the math is going to work out over blocks of decades. And I would like to hope that a family office with a legacy, children and grandchildren, they have liquidity. Well, in real estate, you never know. But let's go with the word they have enough liquidity. They are looking long term. And yes, you could invest in something, especially real estate, where a block of 5 or 10 years, it's just not in your favor. Is it going to stay that way forever? Would it go to historical norm? Do you have to adapt? I'm not experienced enough in real estate to know that, but you've been around for decades. You've seen it all.
I'm going to still, very respectfully disagree with you. For the long term, I think it's the opposite of what you're saying. Slow and steady is going to crush it in the race. Warren Buffett, he's got all these great quotes. It's like somebody said, why doesn't everyone do what you do? And his answer was, because people don't want to get rich slow. And his point, he's really good at quotes, but his point is if you focus on, actually, let me go another Warren Buffett quote. You probably heard this. There's only 2 rules he has. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Okay. And his point is not just to be silly. I mean, he's pretty smart. His point is, I don't care about winning. I care about not losing. And having, been around, as you say, for a zillion years in real estate, the clients that I have seen consistently outperform and literally make billions over many years think that way. They say, we don't care about swinging for the fences. We only care about not striking out. If we think that way, all that will happen is sometimes a bad deal will break even, okay? And a good deal will get 15, 20%. But over the long term, we're going to kill it. On the other hand, if we swing for the fences, we strike out, we lose our capital or part of it. And in the long run, it's actually worse. And so I do actually disagree. I think if I'm a family office, I'm a billionaire, I want to provide for the next generation, I'd be teaching my kids, don't gamble. The upside doesn't really matter that much, but the downside can wipe us out. So don't do that. Instead, do the opposite and make sure that every time you're investing, you're thinking about not losing. And it sounds like the same thing, but it's really not.
I understand, Bruce, and I think that for many people that could make sense. They should at least be familiar. It's not my favorite quote from Buffett. It's probably one of my least favorite. I actually bring it up from the other perspective. The challenge with that, from you brought in heirs, children, which now are a little bit in my field as well with family office issues, that tends to teach a little bit of, don't do that, Johnny. Be very, very careful. You didn't build this money. I did. And you're going to have that burden, that stewardship. You're going to be rich, but don't blow it. And I think that tends to what happens with wealthy families, shirt sleeves to shirt sleeves in 3 generations. It tends to make it I think an important, boy, I'm going off on a tangent now. I think an important thing in families is courage. Now, I have a little bit different DNA. We're all different. We all have different perspectives based on our DNA and our experiences. I'm a little bit more of a risk taker. I enjoy watching entrepreneurs that I can name, Elon and others, that I think they're mitigating risk as much as they could, but they're also going out there and I know most people are going to disagree with me, swinging for the fences. I'm just afraid of your approach might be the safer approach. I don't think it's great for teaching children and grandchildren how to be dynastic wealth creators generation after generation.
So really, look, I got to tell you, that's a really good point. Because, argue against myself and in favor of what you're saying. There's certainly a lot of examples that dad did it, like he had a little notebook and he'd walk around and he'd count how many, people went into the shop every morning, and that's where he knew where to buy something. And today it's like, there's like apps that do that, a billion times better. So I do acknowledge that. One last thought. I'm not sure I'm right. I'm going to just throw this out because this is a nice discussion. I wonder, to harmonize what we're both saying, is this: if you're sort of a little bit more of a risk-taking profile, my favorite phrase, be overpaid for risk. So let's sort of mix together what we're both saying. So if you're investing in something where you're putting, a lot of money to work, your upside is doubling your money, your downside is losing a good chunk of your money, I don't like that risk reward profile. On the other hand, if your upside is 10x on your money and your downside is losing your money, the risk profile is very different. It's almost the difference between a VC investor and a, kind of boring, safe investor. So perhaps the way to harmonize this is when dad is talking to Sonny Boy or Sonny Boy is talking back to dad, it's like, look, if this is something where the reward isn't that high, it should be super conservative. There's just no reason to take that kind of risk. On the other hand, if you've really got a chance to take $1 million and make it into 10, 20, 50, or even a unicorn, $1 billion, that may be a wonderful risk reward profile. And maybe the ideal family office is able to do both. I don't know. Does that make any sense?
I think that makes a lot of sense. I talk about there's certain things that are worth effectively the risk. You hinted at it. Suppose I have a 10x or 100x opportunity where I'm putting in 1 to 3% of my capital, and there is a chance I could lose it. It would be a bad day, but I easily live to fight another day. But if I win or even half win, it's tremendous, which relates a little bit to a barbell approach. Some call it 70, 20, 10, where maybe there's 10% of my capital that is swinging for the fences and I'm more conservative on other parts of it. I'm going to change the direction a little bit, but we may end up also quasi-disagreeing, but you'll kind of bring us together a little bit. I went to New York, I would say, during about 6 months into COVID. So let's put it at August of 2020. And here I thought I was a big prognosticator. I went on my video, New York is dead. It's never going to come back. James Altucher, much more popular than me, basically said the same thing, and he got slammed. I'm not that popular, so I didn't really get slammed. And then I've been to New York, I don't know, 200 times in the last 4 years since then. I got to tip my hat. It did bounce back, especially among the young, much, much better than I thought. But, and maybe I'm a little bit of a negative person at heart, which is sad, I still see cracks. I still see weaknesses, broadly speaking, in cities and the challenges that many cities are going through, including a good number of very wealthy people in our backyard, greater New York, that are going to Florida. And it's a brain drain. It's a tax drain. What would be your prognostication? You got your boots to the ground in real estate in New York. What's the good and what's the bad?
I've been kind of. I've been bullish on New York forever. And I try not to have my brain, trick me into thinking I know more than everybody else. But when it is actually, I think the first Real Estate Philosopher article I wrote, I don't even know, 10 years ago during Brexit, I said, London will be just fine. And I said, why? It's because the talent is there, and talent likes to be with talent more than anyone else. So where is it going? And then during, I can't remember which downturn it was, maybe it was the financial crisis, same thing about New York. It was like, unless the talent leaves, where else are they going? And then today, whether it was COVID or all the other things, there's always so many things pouting on New York. It's bad. It is bad. New York is the food capital of the world, which I'm really happy about for personal reasons. I mean, it's known as the financial capital. It's becoming the educational capital. It's maybe number 2 in the tech capital. I mean, like everything happens here. If you're a 2-earner household and the husband's in tech and the wife is in education, one person can have a career in Silicon Valley. They can both have a career here. There are so many reasons to be here, that I really didn't like Frank Sinatra so much, but I love that song. If you can make it there, you can make it anywhere. Pools of capital come here. There's just so much happening that one way or another, New York always seems to reinvent itself against the naysayers. And that's been for hundreds of years. And that doesn't mean it will continue. The thing that I think was the most awful about it, and I hope I'm not stepping into something, was, I think the political spectrum had moved, too far in one direction, kind of against business so much that I think it was becoming very, very painful for people to do business here. And I think the pendulum's moved back. It's, it's kind of, more in the middle than it used to be. And I think that's healthy. And it's one of these things I've felt my whole life. Your strength is your weakness. The strength of New York is the complete diversity of human beings, of everything. Super rich people, people who haven't made it yet, people trying to make it, wacko people, crazy people, wonderful people, jerks. Everything is here. You walk down the street and you see every race, creed, color, sex, religion, people dressed, all of this. It's kind of amazing. But then again, that can become a weakness if people turn on each other. And I think it's hopefully moving in a healthy direction. But all of this sort of, I don't know whether it's a witch's brew or a magic formula, one way or another, New York always seems to kind of move in a very cool way. And, my love for New York hopefully isn't affecting my analysis of it. But I would say that if one could figure out how to invest in New York, the odds are really good you're going to do very well, if you do it smart. I don't know. I probably babbled a little, but that's probably the best I can
know that's very helpful, Bruce, as you probably learned in the last 45 minutes. And this is definitely not going to be an hour. We're going to have a really good long talk, and I'm going to promote it very well, I promise. You're doing great. And I love the fact that we're disagreeing here and there. Not enough people do that because, I don't know, they want to be politically correct or they're a little bit afraid of confrontation. You and I are old school. I'm not that much younger than you, so we come from a little bit of a different era. And I'm a New York guy at heart too. So I was wrong in 2020. By the way, I'm wrong.
Can I just brag a little bit?
Okay? Of course.
So I put out an article that was, New York's going to kill it. Anyone that thinks everyone's moving to Florida, you're totally wrong. And then a week later, Seinfeld said the same thing. Now, everyone's heard of Seinfeld. Nobody's heard of me. But I was very proud of myself that me and Seinfeld, who I've never met, of course, were on the same thing. And, I predicted, that there was going to be what I called a big V recovery, which there was. And a lot of these, angst and incredible negativity were temporary and overstated. And so I did stay true to my belief in New York for what that's worth. Anyway.
No, actually, remind me. It was actually Seinfeld who responded back to Altucher summer of 2020. And yes, I agree. Me and Altucher ended up being wrong. And you and Seinfeld and many others ended up being way more correct. There are parts about New York that I love. I agree with you. It's wickedly resilient. Yes, they're losing people, and that could be a challenge relative to the tax structure, weather, which they have no control over as I get older, and they want warmer weather, etc. But there's new people coming in. There's young people that bring vibrancy and that change the dynamic, and where business and money is being made. It may be going a little bit more away from traditional and finance towards tech and some of the things that you noted. One thing that I'll slightly disagree on, yes, food from an importing perspective and our ports, but you're talking to someone who does personal advice for the super rich on what's called sovereign risk and disaster preparedness, and all cities could be at risk for this. But if something were to happen, Bruce, we're pretty old. Remember back in the big blackout in, was it 1977 for like 2 or 3 days? If we were to have something like that, and today's world is technological and so connected, yet we lose that capability and there's no incoming fresh water, food, and that could get ugly in a place like New York. But I could probably say that about any city. Here's what I will state that a lot of people around the country just don't understand, but we do, and New Yorkers do. We could drive an hour and be in Putnam County. We could drive 2 hours and be in the Catskills. We could drive 3 to 4 hours and be hyper remote. New York State, by Eastern standards, is a relatively large state. And other than New York and pockets, is probably more suburban and rural-esque than a lot of people think.
It's a, you know, something, you're right. And it's a scary point and a good point. It also reminds me of what I think maybe the biggest Achilles heel of New York right now is getting into it and getting out of it. I live in Jersey. By the way, my wife thinks Jersey is the best kept secret in the country. I think she's right. It's the most densely populated state. It's next to New York City, not far from Philly. There's the Jersey Shore. There's beautiful. It's wonderful. I love New Jersey, maybe more than New York, dare I say. But here's the thing. Just 2 nights ago, Sunday night, we rent an apartment in New York now, tried to drive in, and it just took like almost 2 hours. It's Sunday night. It's like, what are all these people doing on Sunday night driving all over the place? It is hard, really hard, brutally hard to get into New York City from outside New York City. This is the worst thing, I think. I don't say the worst thing. One of the worst things going on because it cripples office. Because, it's like, even if you have a wonderful office, wonderful people, wonderful everything, you still have to get there. That is a pain in the neck. It's very, very difficult. And I think it really, really hurts the city. What can be done about it? I haven't a clue. I think they just announced they were going to do something in Penn Station. And I'm pretty sure that I'm hoping that I retire before they start, because I think it'll take 12 years, cost $50 billion, and make a huge mess before something happens. But it is a problem in New York.
Well, I mean, Bruce, the converse of that means it's buzzing. Things are happening.
Oh,
People
absolutely.
are here. They're driving. So I could, because I'm not living there, I don't have to worry about it as much as you are going in every day. It's a charm when I go there on average, probably twice a month. What would you say from a real estate perspective? We're all familiar with COVID. New York was hit very hard. Office space, the dynamic is changing of a work environment. New York, and you hinted at it, if I own multifamily real estate, it may not be the best from me being an owner perspective for a variety of reasons. On the other hand, it's got a hundreds and hundreds year track record where it keeps on going up. Therefore, at least longer term, what are you seeing with your ears to the ground in the New York real estate industry?
So, I mean, I think it's just like changed in the last month or 2 or 3. There were very few properties changing hands, for the reason that, by the way, one of my real estate philosophers is probably coming out as we're speaking, but, people trying to predict what was going to happen with the election, with interest rates and all these other things froze activity for a bit. So there really hasn't been much in terms of that. In terms of things I've actually seen happening, I have a law firm here. And if you'd asked me at the beginning of 2024, what practice area would be doing the worst in my firm, I would have picked unquestionably office leasing. I would have said, oh, it's dead. Nobody's leasing offices. Of course, since I'm so bad at predicting the future, it's been the absolute opposite. Our office leasing lawyers had the best year I think maybe they've ever had in their career. It's off the charts. Like, all this stuff is happening. This isn't exactly what you asked, but I will say if I were a billionaire and I wanted to invest in New York, there's no question what I would be looking at. I would try to buy a decently located office, class B or C office building in Midtown Manhattan. And I would try to do it in a way that, however bad it was, I still at least broke even. Because I would say I'm buying low, maybe selling high. And my thesis on this is this. I actually will stick my neck out, and maybe you should delete this part from the recording in case I'm totally wrong. But
that makes it more exciting, actually.
I think you're going to see an office shortage in New York. And here's why I have this theory. And remember, I try to come up with things. I think of them. Sometimes I'm just dead wrong. I'll own it when I'm wrong. So far,
I understand.
But, so whatever it was, 5 years ago, the office market was, healthy. I don't know if it was robust or crappy, but it was fine. There was a bunch of offices and people in them. Then COVID went along and it was work from home and all these other things. Now, what you have today is this sort of push-pull with work from home. You have a tale of two markets. Class A space is leasing overall like crazy for $200 a foot. It's doing awesome. And then Class B and C is supposedly left for dead. These buildings will be, fall into the ocean or sink into the swamp or something like that. But then you look at like the people in New York City from a business side. If you can pay $200 a square foot, I mean, that's a lot of money. I mean, if you 10,000 square feet, that's, what is that, 20 million a year in rent? Or 2 million, whatever it is. It's a lot of money. 10,000 square feet is not that much. Is 2 million a year. Our offices are 50,000 square feet at 200 foot. It's $10 million a year. It's incredibly large. I believe there are a ton of parties that were there and still need to be here that have to be in New York City because that's where their clients are. They can't go to New Jersey or Atlanta or wherever. They have to be in New York, and they can't afford $200 a square foot for the Class A. So their options are a Class B or C building that's well located, like the building I'm in right now, or I don't know what they do. Now, there's all this other stuff about, shrinking your footprint and all these other things. And I agree, those things are contrary to what I'm saying. But at this point, when you see office buildings, being somewhat repurposed, somewhat just shut down, all these things happening, fear and greed, I think that, fear is turning to greed on Class B and C buildings. So if I were an investor, that's where I would look. I would also, be pretty brutal on myself with underwriting and all those other things and try to make sure that kind of no matter what happened, I at least broke even. I don't want to lose. But I think the risk reward profile there is pretty cool.
And what do I do, Bruce, if I'm interested in maybe understanding the New York market? Of course, we all know now to go to Bruce, but suppose I want to have your word earlier, diversity. And I want to look at Miami. I want to look at very trendy would be like Nashville in Tennessee, Austin, Texas. How would you recommend for a family office? Do they reach out to other families they may know in those areas about who has their boots to the ground? What's the proper legal representation? Do you have a global network? How could they spread out and become more diverse in their geographic interest here in the U.S.?
It's a tough look. It's the right question. It's the tough question because and I think it probably depends on how much money you have to spend. I mean, if you've got $1 million, you can't really do much with it. If you've got $1 billion, you could do a lot more. It depends on what it is.
Maybe
if you're writing small size checks because you want to put, let's say, I don't know, pretend there's 50 gateway cities. You want to put $2 million to each city. That's $100 million. That'd be a lovely diversification. But you're going to have no rights. You're going to be a vegetable with no legal rights in any of the deals. You're basically going to have to be passive completely because you're only writing a $2 million check. On the other hand, you take the whole $100 million and you plunk it into a big building in one of those cities like New York. You're going to probably have enormous rights. Maybe you'll even control the deal, but you're on the opposite end of the diversification spectrum. So there really isn't a great answer, except it's probably something, that you have to decide yourself. And it would be a mixture of like, what do you know about the different markets? How able are you to put the money to work either yourself or through a third party that you have some sort of relationship with, what we talked about at the beginning of the call? All those factors are going to go into it. So I guess if you gave me half an hour, maybe I could come up with like a real roadmap of exactly how to do it. But I think one thing we both identified is, there's a loveliness to diversification, but there's an ugliness to it that you're going to lose so much in terms of legal rights in the deals and probably upside, that's going to hurt you the other direction. So I don't have a great answer here for you.
Probably a little unfair for you because you're going to be more New York centric, but broadly talking, I named three areas: Miami, Austin, and Nashville. It doesn't take a genius to say that those have gotten favorable population growth. So again, supply and demand, and they have been very attractive. Are they overheated? We saw parts of South Florida, the prices come down a little bit. But my bigger question is not about those, but I'm thinking aggressive. How about San Francisco? San Francisco's been beaten up. All the problems you mentioned of New York, I could argue were 3 to 5x worse, and I've been there in San Francisco. Now, that also caused unique properties that's got beautiful architecture to come down in price. Is it at a bottom? And is that a good time to buy? And I know you get a little excited about this word, distressed, and you disagree, you're a little contrarian on what many people would think about. I got dry powder, I'm looking for a distressed opportunity. San Francisco may seem interesting, or is it too early? Is it never going to bounce back? And what's the fallacy of always looking at distressed?
You're making a habit of mixing a bunch of questions. Nice and tricky.
Welcome to my brain.
So, no, but that's good that way. Look, I'm 100% sure that I have no clue whether San Francisco hit a bottom. I was there about 30 years ago. I read what I read in the paper. I guess it's in sort of I think it's called a doom loop of, things just getting worse and worse. I'm going to make a guess that the odds are, if you could get stuff cheap enough, you're probably going to do well. It's just a random, guess about San Francisco. The point you just mentioned about distress investing now is one of my recent articles. I think it is a red herring, and I think it's a poor investment plan over the long term, looking for distress. And there's a whole bunch of reasons for it. But, in the end, distress, is sort of this dream, the billionaire guy or the guy, who's running a fund with $1 billion in it. He's like falling asleep and he's thinking of like the movie Oliver Twist. He's sitting there, with a big pile of money, and they're all lined up coming to him. Please, sir, I want some more. Could you please give me some of your money? I will pay anything for it. That's the dream of a distressed investor. And you know what? 20, 30 years ago, I think that dream was maybe achievable because everyone didn't know everything and all this other stuff. There wasn't like trillions of dollars just going around the system. 2 years ago during COVID or whatever it was, I sent out an email to the Real Estate Philosopher list, goes to 50,000 people. And I said, look, we're going to put a little hub together. Parties that have capital to work, let me know. And then parties that really desperately need the capital, let me know. So what happens? I got a pretty high response rate because usually people don't actually respond. They read it, make fun of me privately or publicly, but then they don't really respond. I think it was 47 responses. I want to ask you a question. Of the 47, how many had capital that they wanted to put to work, and how many wanted it?
Probably 47 wanted it.
You're right. And no, we didn't rehearse this ahead of time. You're totally right. 47 parties said,
I knew it.
We got capital. We'd love to do this. Now, nobody wanted it. So, when these distress opportunities happen, the theory that you're going to be overpaid for risk, because that's what it's all about in the long run, I just don't think it's there. So let's say you do find somebody that does desperately need the capital, and you're all excited to give them $20 million at 20%. Now, if the guy's stupid, he'll just take it. If he's smart, he might call a broker and say, look, I got this shit deal. Sorry, am I allowed to say shit on this?
Of course you are, and worse.
Oh, God. Okay. So I got this bad deal here, and I'm taking $20 million at 20%. I was a math major too, like Bruce, and I know that's $4 million a year I'm paying just in interest. It's going to destroy the upside of the deal. Mr. Broker, do you think you could do any better? The broker's like, well, let me reach out to 4,000 people. I got news for you. Somebody was going to give him at 20%. Somebody else will do it at 19, and somebody at 18, and somebody at 17. But since there's always an enormous pile of capital, the odds are pretty darn high that the market will equilibrate pretty quickly to whatever the the non-overpaid or underpaid for risk is for that investment, if I'm saying it right. Maybe it's 14%. That means it's fair. The investor's getting a reasonable deal. The other guy's getting a reasonable deal. Nobody's being overpaid. It's not this amazing deal. It's just an investment. So the problem with investing in distress is that you don't get the amazing opportunities that you think very often. Occasionally you do. But meanwhile, you have to have a whole office running, looking for it. You know, unless you're just sitting there by yourself, you're hunting for this stuff. You have to pay people. You have to run this whole thing looking for distress that usually comes along for 90 days every 3 to 10 years, and then it's gone. And I think that is just not a way that is going to allow you to outperform. That instead, everybody should have distress investing as a tool in the toolbox. Because when there are these chances, you want to grab them, but you don't want it to be the business profile in and of itself. Whether you're a lender, an investor, a GP capital guy, this guy or that guy, or recapitalization guy, whatever it is, I don't think distress should be the point of the business. It should just be a tool in the toolbox. I don't know what that says about San Francisco, except that you should be looking there. Maybe there's amazing opportunities. The odds are it'll be okay at some point, but I don't know if that's 20 years or 20 minutes.
But what edge are you going to have competing against insiders that know the political situation, arguably may have some influence with the mayor and council, even with the governor, which goes back to what you said, and I kind of hinted at earlier. This is a tough business. Like, you're not just going to walk in there and do above an average, which is why, because I don't have deep experiences in real estate, I look at it more ancillary. It's not core to what I do. I think it's way harder than equities, but that's just me. Related, and I want to be respectful of your time, probably have about 4 more questions left. Inflation was out of control. It appears, although I don't know if I always believe the numbers, to be a little more contained. Interest rates went up. They're now quasi coming down, but a mortgage compared to when I got mine 8-9 years ago is way, way higher. So how do you look at, in advising investors, family offices, the interplay of the challenges of interest rates and inflation relative to investing in real estate?
It's kind of funny because the article that I literally am sending out as we're speaking, it's going out, deals with that. It says, don't even waste your time. Inflation, I mean, do you remember in the old days, like, real estate is a hedge against inflation? Like, it's supposed to go up if inflation goes up? What about that? And tell me, do you have a crystal ball that you know what the interest rates are going to be? Nobody knows these things. It's a waste of time. It is a total waste of time to try to predict interest rates and inflation, all this other stuff. And it really is like a little rant for me that people spend so much time doing this. Interest rates were insanely low 2 years ago. Everything was wonderful. The world was on the best in the world. That was the worst time to possibly invest, right? Because nobody knew what was going to happen next. You know, and then all of a sudden interest rates went up and everyone was like a calamity. And now everyone's like, oh, they have to come down. The bottom line is nobody has a clue what is going to happen to interest rates. Even if you're absolutely right on, so there could be another pandemic and they could drop. There could be a war. There could be this. There could be that. Going with Warren Buffett again, he says, if I knew every single thing the Fed was doing and would do, I would not affect any business decision I ever made. Mm-hmm. And I think that should be true for real estate players. Yes, it affects the price. Of course it does. But that's just the price right now. The future, you don't know. And once you say, you know what, I don't know, I don't care, why waste time on it? Let's do some good underwriting, create some good deals, and put my brain to work in a place where I can actually create value rather than a fool's errand. I mean, do you really think you and me could sit down with a bottle of scotch, like all the scotch behind me, chug down the scotch and figure out interest rates? Come on, nobody can do that.
We could invite Jerome Powell. We'll have a good drink there, Bruce. Come on.
Okay. Even he would probably change his mind in a month because something else happened. You know that.
How do big picture, more macro things and how they impact real estate in New York? I'm thinking of, we're told that populations are going to be declining. The average couple, so that's 2 people, quote unquote, getting together, is having 1.3 kids. So they're not replacing themselves. This will take decades to play out. Yes, immigration could impact it. But in general, the decline has been consistent in the West, per the example that I gave, and really not just the US, the West, for decades. Now, there might be a savior that we're going to get to, AI, robotics, and things like that. But do you think that's looking, again, crystal ball too far down the road? Or do you look at demographics and how that plays into supply and demand?
Well, I think anyone, would want to be thinking hugely, like, people either coming there or, making babies there. By the way, after this, I would like you to call my daughters, and, I have 0 grandchildren, and anything you could do would be appreciated.
I would love to see that changed. I want you to be a granddad. You'd be a great one.
But I would think the answer is, it's probably the easiest question you ask me all this time, is yes, of course. If human beings are, either multiplying or going there, that does enhance the chances that real estate will become more valuable, and whatever you're doing, creating, hopefully not finding, but creating there has more reward for the risk.
Of course. And I guess it was an inevitable and actual answer, but I'm glad that we completely agreed. Yeah. Oh, you said a lot there that I could comment on when I talk about geopolitics and societal issues relative to children and all that. But let's not get in trouble today. We could save that one. I get in enough trouble on my own, Bruce. I don't want to drag you into it. But a great honor would be, I agree with you, to be a granddad myself. So I look hopefully forward to that day. And when I'm asked about whatever billionaires and the rich and a little bit more in our age bracket, it's a no-brainer. The most important thing to them is the future of their children and grandchildren. Almost nothing else matters compared to that. So, and yes, I could probably tie that into real estate and other investment plays, but again, maybe we'll save that for a part 2. But I think that question does segue, and you said this word maybe half an hour ago. The world is changing. We have AI, and I actually think AI is underhyped. That's going to lead to things like drones and the changing of delivery and Amazon, robotics, and that could have a bigger impact on industrial real estate if you wanted to touch on that. And again, I know it's a crystal ball question, but we have to prognosticate somehow. How do you look at the impact of all those things with advanced technology led by AI, robotics, and the impact on real estate?
Did you read my article before?
Maybe I am an Nostradamus. Maybe I do have that crystal ball.
Maybe you're reading it on the screen, and when I'm not.
I'm tricking you. Yes.
Well, I see 2 things. By the way, my daughter works in the AI division of Google, so she tells me all sorts of stuff. But I kind of see there's sort of 2 things going on with AI. And I start with Bill Gates' famous quote that people tend to overestimate what will happen in 2 years and underestimate what will happen in 10 years.
It's a great quote.
It really, and I think that applies here. So in the short run, I don't really think AI is doing that much to the real estate world. I think when I want to piss off my daughter, I tell her that AI is a glorified spell check. And what do I mean by that? It means if I'm doing something, okay, I don't want AI to tell me what to do, because that's very dangerous. But if I think I know what to do, it's a great idea to ask, maybe I missed something. I mean, theoretically, AI chomps through all the knowledge of humanity and tells me maybe I missed something. So it's like a huge spell check, whether you're a developer or a purchaser or this or that, or if I were in the real estate business, buying, selling, borrowing, lending, all that stuff, I would be just, as a habit, when I'm about to do this deal, plug it in, see what ChatGPT says about it. Maybe they're going to find something I missed. So that's one thing that's happening. Along the same lines, I think it's an amazing efficiency generator. A lot of tasks that used to take this long could take that long. I don't know if this is politically correct, but I'm guessing it will eliminate some jobs and actually probably create some other jobs. All that stuff is happening, but I don't see that it's like some dramatic change in the real estate world that we should all be shrieking, AI is coming, run. That's the short run. Over the next 10 years, I don't even have a crystal ball to figure that out. But I am fairly confident, like probably Mr. Gates would say, that whatever we're doing now, we probably will be doing something dramatically different in 10 years. So even if you agree with me that maybe not that much is going to blow things apart in the next 2 years, you should be all over it. You should be very vigilant, looking and thinking, like, how is this going to change things? The last thing I'll say is, and I'm not sure this is a sleeper issue. I thought of it today, but maybe everyone already knew it and it's obvious, or maybe I am truly a genius that thought of this. But one thing that I think may be huge in the real estate industry for AI right this second is the effect on our tenants. If you think about every real estate deal, like the oil that powers the ship comes from the tenants paying rent, either the buyers of condos, the renters of condos, the commercial tenants, the industrial tenants, all of those parties put money into the real estate world and we get money from it, right? That's where it comes from. Instead of focusing so much on how the AI will hit the real estate world, I bet it's a lot bigger and more important to focus on how it's going to hit a lot of these other businesses. Because real estate, for various reasons, I don't think it's hit as fast as other businesses. Some businesses have been like wiped off the globe already. Like I can't remember like people who do some sort of like, drawing pictures or something, that made business be gone. And then other businesses are maybe going to grow dramatically. So I would be thinking, if I were a real estate player, let's look at my tenants and let's do an analysis before I buy or lend on something. What's AI going to do to these tenants over the next year or two or three? That might be a lot bigger than what's going to happen to my real estate business. Anyway, those are my thoughts, right or wrong, but that's what I'm thinking.
I think that was kind of brilliant, Bruce. I completely agree. Not that maybe that matters, but in the family office world, I'll throw it out there. I think I've been the most active in trying to see around corners in the world of AI by far than anyone else. That has taken me to Silicon Valley multiple times, an active investor in public and private deals, and broadly agree the impact on our life in the relatively short term is subtle. But you are correct. I'm glad you said 10 years and not 50 years. It will be significant, even broaching 50 years. Your daughter, in those enjoying a nice scotch behind you and really opening up and sharing some insight, what's going on. Look at quantum computing evolving at Google and them playing catch up in other ways relative to AI. It is underhyped. It's just not quite as practical for many of us yet. But within a year to a year and a half, we're going to see that uptick a lot. Keep an eye on AI agents. So yes, I could have a lot to say about that, but this is not meant to be an AI discussion. My last question, which relates a little bit to the world that also for some is a little what they deem to be out there. Some would say blockchain, crypto, tokenization. There was a lot of talk and it didn't go anywhere or didn't go far in the current administration with Gensler and the SEC. There appears to be no question the world of crypto and everything around it is going to open up, I guess, under Trump. Who knows until we actually see it. But the world of blockchain and tokenization of real world assets, are you hearing a little bit of buzz, maybe from the children of the billionaire real estate people that you know, that the future of buying and selling real estate may be radically different and very unique in the coming years?
I heard buzz on it, whatever it was, 3 or 4-ish years ago, and then the buzz totally went away. I've not heard the buzz back yet. I will make a prediction, maybe not a pretty one. It's this: the token. Using the word tokenization, which can mean a whole bunch of things, but using the word tokenization of, let's say, a building or portfolio or whatever it is, has a lot of pizzazz to it. It's like, here's this building. It's worth $100 million. There's a $50 million mortgage. There's $50 million of equity. We're going to sell tokens or whatever we're going to call it, for $48 million. The sponsor will keep, $2 million in it. From the sponsor's point of view, my instinct is this is fantastic. Okay. Because there's ways to sort of, if the market goes down, you buy it cheap. And if it goes up, you sell, and you can do all sorts of things there. But from the point of view of the people buying these things, I would suspect these people are the least knowledgeable and least able to protect themselves. And so I think it's probably a very poor risk reward for token buyers. And what might happen is if the, animal spirits boom thing that goes on now lasts for a few more years, I could see this really taking off. and a lot of buildings turning out this way and people piling in and prices, going up, and then that inducing other buildings in. But at some point, I could also see kind of a pretty big crash in it, where just like we watch crypto go like up and down like a yo-yo, I would see the same thing here. So as long as, my client, let's say, we're doing the tokenization offering very, very honestly, honorably disclosing the risks really well, I would say that's a great risk reward. As far as me or my kids or others, I would be a little bit, very leery about buying these tokens.
I don't disagree, but I have a little different twist maybe towards the end. Yeah, it's probably potentially great opportunity for the seller and those more sophisticated. The challenge, and again, I know I'm a mouthpiece for the wealthiest of the wealthy single family offices. At least that's what I get called by the media and some others. So I've thought about that in other ways of venture investing where no, I got to be an accredited investor, or in some deals, a qualified purchaser, even a higher standard. And does that make the rich richer because they have opportunity for deals that the masses don't? Now, on the other hand, you stated, and things will likely change with the SEC, where let's call it traditional or regular investors may have an opportunity in tokenization of real estate and venture capital. And what's going to be the qualification? Maybe they do a 3-hour online course and pass the test. I could paint a negative picture. There's going to be bad apples and bad things are going to happen. But I could paint a positive picture too, that now they have some of the same access that I do and others do. And it creates an opportunity for them to learn more, become more sophisticated, learn how to manage risk. And as opposed to us holding their hand and no, you can't do that. You're not sophisticated.
Well, wait, one sec. I'm not saying this should be illegal by any means. No. I'm saying that the risk reward profile for these token buyers is a very poor one. The thought that they are somehow going to take a 3-hour course or walk around the GM building and decide it's a good deal, they have zero chance of being able to evaluate the risk reward on this investment, unless, of course, they're real estate players, in which case they probably, wouldn't do it anyway. So my issue is, shouldn't be illegal. It should absolutely be illegal as long as people are disclosing the risk honestly. Yeah, that's capitalism. That's totally cool. But I don't see why we're, helping the common man and woman, get access to great things. When we talk about that, it's more like you're going into private equity where there's hopefully a brilliant investor investing and you're piggybacking on him. This is the other way around. The brilliant investor is the opposite side of you. So I'm sorry, this one, I think we're agreeing it should be totally legal, but I don't think the risk reward for the token buyer is good. I personally wouldn't do it. And I'm sophisticated, but I'm smart enough to know I don't know one building's value from another. I have no way to know.
Fair enough. We disagree a little bit on that one, which is great, by the way. That's why I love this discussion, because I learn from listening to other perspectives, and you cause me to think and think for myself better than me getting trapped, like a word you used earlier, confirmation bias and other biases. I think it's important that we do keep an open mind and that we always be learning. Bruce, I really, really enjoyed today. I learned so much. I do look forward to a part 2 sometime in 2025. How could people get on that email newsletter, reach out to you, inquire about the services of your legal firm? What are various ways they can learn more and connect?
All right, I'll be really brief because this is the time when people think, some lawyer's going to talk about himself. So in terms of the Real Estate Philosopher, just click on, Google Real Estate Philosopher. You'll see more than you bargained for. And it's real simple. There's no cost. You just get my emails and you can, benefit from them or laugh at them, but they will always be my honest and thoughts of whatever it happens to be, just like the things we're talking about today. As far as lawyer stuff goes, I'm the chairman of Adler and Stachenfeld. It was very well known as Duval and Stachenfeld till a couple of years ago when we elevated Terry to become named partner. She was a founder of the firm as well. She's one of the top lawyers in the city. The things that are cool about us, there's 3 quick things. One, we are the pure play in real estate. We're 50 lawyers. That's all we are. It's small compared to the mega firms, but we are 100% real estate. It's the only industry. We're all over at every possible angle, which provides a lot of benefits intellectually and from our client's point of view, knowing how to get them what they want, because we know what the other side wants and everything else. So pure play in real estate. Second thing is, one of the things that has really been transformational and might be fantastic for your family office, listeners who I do hope will call me, is this. We have a very different business model from other law firms. It's dramatically different. It's 6 words. It's this: help our clients build their business. That is our magic formula. Pick a metaphor, whatever you like. What I mean by that is we try to learn everything we can about our clients on the business side, their business plan, marketing plan, competitive advantage, lack of competitive advantage, where do they get their money, their deals, their ideas, strategic relationships, who do they need to hire, whatever. We learn everything. And then we try to be a teammate, helping them put it together. Often it's just one party has capital, the other one needs it. We put them together. No, unfortunately for us, we don't get a cut. But this is fantastic for family offices. One thing I will emphasize, probably should have at the beginning of this call, because this is possibly the most important thing I'm going to say. There is a feeding frenzy in the real estate world right now, looking for family offices as teammates, LP, GP, preferred equity, whatever it happens to be. It's a feeding frenzy. I don't think a single client of mine has not said in the last few years, well, if you know a really good family office, this deal's perfect for them. So if you want to be in real estate and you're not, and whatever angle you want, please give me a shout, and I'd be delighted to introduce you to our clients without getting a cut. Either I'll be on their side or yours. The last thing I'll say, and now you will make fun of me, is our hedgehog. Okay, I don't know if anyone's watching or just listening.
They'll watch it.
Okay, well, in that case, they see all the liquor behind me. My wife says it gives a terrible impression. And it's like, well,
I mean, I smoke cigars all the time, so we both have our vices, Bruce. What can I say?
I like the cigar. She hates them even more than the alcohol. But anyway, the hedgehog, silly as it is our unifying principle. And it stands for the proposition that we really care about our lawyers. We really care about our clients. And it's not just because the lawyers bill hours and the clients give us money. It's because there's something special in the relationship. And all of our lawyers get a hedgehog, and all of our clients get a hedgehog. And we say to our clients, take the hedgehog, don't take it home, don't give it to your kids, and for heaven's sake, don't give it to your dog as a dog toy. But instead, keep the hedgehog in your office. If you're having a bad day, you look at the hedgehog, and you know that there's somebody who sincerely does have your back and care about you, and that's us. And yes, it's hokey. You're probably rolling your eyes. Everyone makes fun of it. But at the same time, we've learned that the same guy that, is making the most fun of the hedgehog is the one that calls me up and says, Bruce, we just hired Toby. You didn't have his hedgehog yet. Because they know it's sincere. Hokey or not, we fall in love with our clients. We look out for them. We have their backs, especially in bad times. Anyway, that's all I'll say. And Angela, this was absolutely fantastic. By far, and I'm not just saying this, by far the best, interviewer of me ever. So thank you for doing this.
Wow, I'm really honored. Now I have done like 400 of them. Hopefully,
all right, well, you've learned
a little better. But that's very kind of you. And by the way, Bruce's last name I'll spell Stachenfeld. And one more time, Bruce, for those even on the business front or connecting opportunities, how could they reach out? Is there a website, a phone number?
Oh, yeah.
What's the best way?
If I sound like, like an infomercial, www. Adstack, it's Adler and Stachenfeld, ADSTACH.com. My phone number, 212-692-5550, and it's all out. I don't hide it. So,
well, that's wonderful, Bruce. Again, I became familiar with Bruce a couple of months ago. I enjoy his content. It was an honor to have an opportunity to interview him. For my members, by the way, you're always encouraged to reach out to me, and I can make a direct intro to Bruce. And although Bruce doesn't know this yet, I do usually a monthly breakfast meeting in New York, and maybe once or twice in the coming months, I could invite Bruce to join us at the Lowe's Regency as a guest. And we have this incredible talent that could share his knowledge and answer your questions. And on that note, of course, all of you that are qualified that haven't done it yet, what are you waiting for? What a great end of the year present to go to angelorobles.com And of course, join my membership. It's called SFO Continuity. It's a private club dedicated to incredible investors and family offices. My proprietary content. I'm diligently working on 2 significant masterclasses. I'm going to have them ready way before I thought, which is always good news. Lots of white papers and big events upcoming in Miami and Palm Beach at the beautiful Colony later in the first quarter. So there's a lot going on. Just simply go to angelorobles.com. You'll find it. It's under membership. Join and be a part of it and be immersed in what I do, interaction with me. And that's all secondary. Your peers, that really is the main value. Bruce, again, I greatly appreciate it. Hopefully we'll meet and I'll invite you to that Lowe's Regency breakfast in January 2025. Thank you so much. I look forward to meeting you. Thank you.
I would love to have breakfast with you and whoever's there. So thank you for that. And thank you for the opportunity to talk to your audience.
You're very kind. Thank you so much, Bruce. Thank you. Have a great day. Thank you.